in order to avoid paying taxes in retirement, the government's going to get their money. They're going to get their taxes. And so what we're simply saying is, rather than paying in retirement, you're going to do it now. Roth conversions have become very popular. That means that you're going to be doing some activity now while you're working that will generate a tax.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The advisors discuss some of our firm's investment processes. These are just a few of the many possible approaches to investing. Individual results may vary depending on your goals, risk tolerance, market conditions, and other personal factors. Please consult a qualified financial professional before implementing any investment strategy.
Welcome to the Market Moment. This is Matt here with Lee.
Good morning.
And John.
Good morning.
How are you guys today?
Excellent.
We're good. Yeah.
Awesome. A lot of rain the last few days. It's currently pouring on us as we speak. So fall is here. It's a wet fall. Wet start to fall.
Wet start. 3 months of no rain and then 2 months worth of rain in 2 days.
2 days. Yeah. It's been a lot.
My wife is crossing her fingers that the tree, we got enough rain over the summer that the colors will be
I bet they'll be great.
really good this fall.
Yeah. It's a fun time of year with football and the weather, and I love fall. Hunting season.
You said it's fun time of year with football?
Yeah.
Yeah. Who's your team?
Yeah. That's true.
Yeah.
Oh, me.
Okay, yeah. We'll just pass right
We'll move on. So today we're going to talk about the question that we're going to talk through that we get asked a lot, that really a ton of our planning that we provide for clients is around clients that are nearing retirement, and some of them even that are younger. We're starting to, we plan way in advance. But the idea or the question is like, how do I pay less taxes specifically in retirement? So obviously the goal is to pay the least amount of taxes over your entire lifetime, still, obviously playing by the rules. But this particular question is, how do I set myself up for paying the least amount of taxes or less taxes once I've retired? And so there's a lot that goes into this. We're not going to cover everything. But when you get asked that question, or when you hear that question, what are some of the first things that come to mind, John?
Well, first things this is simple stuff, it's basic stuff, but brackets, right? If you're making $300,000 a year, $100,000 a year, whatever your amount you're making, and you get into retirement, you're most likely lessening the income, right? So your brackets go down. So a lot of times naturally you pay less taxes in retirement just because you're taking less income than you were during working years. That's one. But two, younger folks can take advantage and have been taking advantage of Roths through their life, Roth 401ks and so on. When Lee and I were younger, we didn't have Roth 401k options, right? That's only been around for 10 years or so. So people getting into retirement now often do not have a lot of Roth money, but younger folks listening to this should really think about the Roth contributions they make every year and make an effort to make sure they have that, so that when they get to retirement, to back up a second, Roths are tax-deferred. After tax money goes into them, they're tax-deferred, and then when you start using the money, it's tax-free withdrawals. That's why Roths are so important. For our older clients, what we do in this office a lot is we'll talk about Roth conversions, right? And that's where we, maximize their tax brackets up to certain levels to not go to the next level, but we try to convert as much as we can from traditional IRA to Roth so that the 25, 35 years that they're in retirement, the majority of them, they have tax-free money coming to them. So there's a lot of ways like that. I think when you get to retirement, though, that is a massive question. And a lot of times it's the pre-planning that determine what your taxable situation is going to be in retirement. And it might be too late to make big taxable things. But Roth conversions, charitable giving, there's a lot of things you can do.
I think it's important to note that, in order to avoid paying taxes in retirement, the government's going to get their money. They're going to get their taxes. And so what we're simply saying is, rather than paying in retirement, you're going to do it now. Roth conversions have become very popular. That means that you're going to be doing some activity now while you're working that will generate a tax. So
not deferring everything that you're saving for
that is correct. That's correct. I mean, again, Uncle Sam's going to get their taxes owed. We're just simply trying to do it now so we can, make some changes when they retire.
Interesting planning, though, and I think this is I get a lot of questions of like some people think, and that's happened to me quite a bit. Oh, my required minimum distribution or my RMD, I'm going to have to take all my IRA out at 73 or 75, which is false, right? It's a small percentage of your total balance that starts at 73 if you're born before 1960, and 75 if you're born 1960 or later. But it's just 3.8% the first year, 3.9 the next year, and so on, gradually goes up. So RMDs really aren't a problem for most people. You do need to know that at 73 and 75, you're going to have to take required minimum distributions, but they really don't. They usually fit right in with your income needs and so on. It's not a big deal. But I think that's a misconception, right? We're going to have to take a bunch of money out at that point. A lot of times on the planning on Roth conversions, it's kind of a hot topic decision, but there are things that when we plan for clients, the sweet spot is like 59 and a half and older. You should not Roth convert before then because of a 10% penalty. And then
unless you are ready to pay the tax out of pocket.
Yeah. Unless you can pay it out of top, right? And then there's stuff that can affect your Medicare. There's stuff that can affect your Social Security.
Right. That's what I was going to mention. So there are other expenses that you really could just look at as an additional tax.
Right.
That start to come into play in retirement. One of those examples is IRMAA, so the income-related monthly Medicare adjustment that can significantly increase your Medicare premiums if your income are over certain thresholds, right? And it can go up. There's brackets, right? And so it can take you from, $150 a month to $300 to $600 to $800. I mean, it
can start making a difference.
A material difference. And so it might not be something that you're thinking of like, well, I'll defer this, and then maybe you do get to RMDH. And you're right. That's not drastically changing most people's tax situation.
Most people, yeah.
But if you've deferred, let's say you're not taking any income out of your IRAs and you just defer that and you get to RMDH and you have $4 million in an IRA, then it starts becoming an issue. And now you have this RMD that you've not been taking out. And if you have an income, now you're paying the IRMAA on top of that, which is just an additional tax. And so doing the calculations and the planning ahead of time to think, not only what is it now, what is it going to be in the future, but like what other things that don't even apply now are going to apply later that can completely change the calculations on when and how we should go about paying these taxes. Because to Lee's point, you're going to pay them. Whether you, if you assume the exact same tax bracket today and in the future, then it doesn't matter if you pay the tax now and let it grow in a Roth, or if you defer it and take it out later. Like if you assumed 24% bracket now and in the future, the math is identical if the counts grew at the same rate. So it's truly just a calculation of what brackets do you think you're going to be in, and having money in different buckets gives us flexibility to protect ourselves against changes in tax brackets and changes in legislation that if you have all of your money in one spot in a tax-deferred account like a 401k IRA, that's great. You'd rather have it there than not have it at all, but you're just really limited in terms of how you can use it and what you can pay on it.
We talk about buckets all the time, and I was having this conversation with somebody just the other day that one of our clients has tapped out his 401k. He can't put anything else in there. He makes too much money to contribute to a Roth. And so I made the point. I was like, we need to be building in a taxable account for this very reason. John, you made the point a few minutes ago that back when we were starting, careers, all we heard was defer.
Yep.
I mean, put as much as you can in your 401ks or your IRAs, and you just want to amass this amount of money in tax-deferred
with the
account.
thought that your tax would be much less when you retire.
That is absolutely correct.
Your tax bracket.
Tax laws have changed.
Yeah.
And like you said, it hasn't been up until just the last 10 years or so where the whole idea of Roth conversions, was
even Roth options in 401ks, which if you and I had that 35 years ago, we would have done that.
Yeah. I mean, it's interesting that,
people.
And you bring a good point, is that people could be doing exactly what they are supposed to be doing, and tax law changes can throw a curveball in that. And so that's why it's so important to begin planning, not 6 months before you plan to retire,
right.
but
Years.
5, 10,
years before.
Yeah.
And then other thing about that, the tax laws, we had the big beautiful bill that made the tax brackets permanent. Had that not happened, we'd have had the biggest tax raise in our history of our country, right? Percentage wise. So in 2026, and that would have affected retirees in a massive way. Instead, it went the other way. We've got more tax credits, more things that are positive for people in retirement, but that can change on a dime with whoever's in office and so on. So preparing for retirement and then having reality hit you in retirement is two different things. So I always think of it like, if you're young, it's great. Have 3 buckets. Have your tax deferred, which is your 401k. Have your Roth, if you have the option in a Roth 401k or do it on your own. That's the best option in my opinion. But then have the taxable account as well.
Sure.
How many people do you guys meet with that say, I want to retire at 52? It seems like the younger people now that are like 50,
this was the
54.
conversation I was having is, if you decide to retire prior to 59 and a half, you want a bucket of money to pull from before you have to go into your...
Because if you don't, you're going to be paying a 10% penalty.
Sure.
You're going to be paying the regular income tax, and then it becomes a burden that you had money in your IRAs and had no other buckets.
And we may have mentioned this, and forgive me because I was on my computer and not paying attention there for a couple minutes. But, one easy way to save on taxes is delay your Social Security benefit. There's a lot of people that come into our office that think that, man, I'm turning 62.
Right.
I want to take it, whether they need it or not.
Right.
And so one easy solution is defer Social Security payments as long as you can up until age 70.
70, yeah.
That is an easy way to save on some taxes.
Our planning software that we use, right, it assumes everybody's going to live to 95, which is the one thing we do not know, and we can't officially 100% accurately plan for. But when you assume 95, 70 is always the best time to start taking Social Security. Our software tells us every time, right, that you should wait till 70. So the point is, if you don't know when you're going to die, which none of us do, then deferring it as long as you can. If you feel like you're healthy and you can live a little bit longer, there is a break-even point somewhere in there. But that's a great point, Lee. And then,
we were joking right before we went on air. When we knew what the question of the day was going to be, I think I threw out flippantly, move. Well.
Yeah.
There are tax friendlier states than others.
We have clients. I've worked with clients who have done exactly that.
Yeah.
To move states.
Yeah.
Now, Tennessee, Florida, Texas, and get your tax-free status, a state income tax-free, which is great.
And another one, and maybe we've hit this topic long enough, but QCDs.
Yeah, I think that's
are
massive.
A way that
QCDs are qualified charitable distributions, which at 70 and a half, now RMDs start at 73 and 75, but 70 and a half, which was once the old RMD age, you can actually take, let's say you're giving $1,000 a month to your church. So that's $12,000 a year. You can actually take that from your IRA starting at 70 and a half, not before 70 and a half. You can take $1,000 a month from your IRA as a qualified charitable distribution. You will not pay taxes on that money that you've taken from your IRA.
Which is huge.
You
get a charitable deduction.
And one other thing to keep in mind, I was trying to pull this up. The Federal Reserve Bank of St. Louis, their chart. I don't know. I was trying to find the best chart for this, but Zoe will throw a link in there so you can see what we're looking at. But if you just look at historically the top and low end of the brackets, like we're historically at a favorable tax bracket.
Right.
Sure.
Right
historically,
now. Like going back to like the 30s and 40s.
Right.
Like we're at about as low as it's been since then. If
Yeah.
you look at just the lowest marginal bracket and the high, and I know there's some nuances there of like where are the brackets and so, but just historically speaking, do we really think with everything going on, our national debt, some of the issues that there's a high probability that rates go lower from here in the future and that you're in a lower bracket? Again, we have no idea. I think from just there's a higher probability that the best case is they're at where they're at now. Mm-hmm. And there's a decent chance.
Hopefully a long period of time.
Yeah, there's a decent chance they trend a little bit higher over time. And so something else to just take into consideration when you're thinking about when and how to pay taxes on your investments.
Yeah, our national debt is all-time highs and seems to be getting worse every day, right? How are they going to get that down? And a lot of, maybe not this current Congress and administration, but at some point, taxes are going to be the answer. They're going to be trying to fight for higher taxes. So to your point, this is a sweet spot, and this is a great opportunity when we bring in clients that are getting close to retirement or in retirement. The Roth conversion conversation is a very big topic and is very real.
And then last point on this, then we'll move on because we've talked about taxes for 15 minutes.
Yeah,
that's
right.
But is if you have access to HSA, contribute because that way, if you're in retirement and you have a year where it's, hey, we've
Health
got
savings account.
HSA health savings account. If you have $15,000 of medical expenses that hit you in a year, and all of your money's in an IRA, and you've got to take a distribution to pay for, then that can again start changing your tax situation. But if you have money in an HSA ready to go, you can take that money out for medical expenses tax free. So that's a really cool account that you can contribute, defer the taxes, put it in income tax free. And then if used for medical expenses, take it out income tax free in retirement. And then you can use it after the age of 65. You can use it like a normal IRA if you need to for non-medical expenses,
which is pretty awesome.
Yeah. So a lot of things, a lot of moving parts, a lot of planning. Make sure you have someone that can help walk through this with you, and run the forecasts and projections and do the math, because there's a lot of moving parts and things like IRMAA. And there are other examples that a lot of people aren't aware of that can really have a drastic impact on your, retirement income and tax situation. So
they're made aware of it when their Social Security is less.
Yeah.
And then they realize, and then they call and they find out, oh, you made too much money, and we had to take more
Medicare
money
premiums went up.
Medicare premium. Yeah.
So, okay, good conversation on that. So, the second topic we wanted to talk to today is what could, or what could would be not what will, but what could stop this bull market. So the market's been strong, right? It's been a good year, pretty resilient market. We had some volatility, it's a little bit of a sell-off in early part of the year, March through the beginning of April. The market's come back strong, had a good summer. What are some things? Obviously, this is kind of a gotcha question.
Yeah.
Just so many. But just thinking about where we're at, some of the risks out there, not that they're overly unique to this point in time.
Right.
A lot of them are the same risks that are always out there, whether we're in a, any kind of bull market. But let's just talk through a few of those things that we think people should be aware of.
Okay. One thing I can think of is like right now, the CPI in the past 12 months is 2.9%. Okay, so higher than it was a year ago at this point. It is much higher than the 2% target that the Fed had set years ago when they wanted to get inflation back in order and they started bumping interest rates up, right? And then the Fed has been pressured, maybe you can call it, it is obviously political pressure, but they've been pressured to lower rates, and we finally had that quarter point rate drop last week. And one Fed chairman who's definitely one Fed.
You did vote for Biden.
Yeah, one Fed guy that is wanting to be the next Fed chairman was the dissenter. He said he wanted a 50 basis point cut, so he's trying to get the attention of President Trump. But we had that rate cut, and that's fine. But when you look at inflation, and it's ticking up a little bit, and you have an employment data, which they revised employment data, and it was not good.
Yeah,
right. We're not talking about that very much, but it wasn't very good. So you combine those things, you could see the Fed is kind of in a position where technically they could say no more rate cuts because we've got inflation back in our picture, and we've got unemployment that's not working right. So you could actually see either a rate stall or a rate rising environment, which I don't think is going to happen because I think the pressures are there to continue to lower rates.
I think they're
starting,
rightly so, because of the data. I think they're starting to be more focused and concerned about the employment situation, labor situation, because it's not what, you think back 2 or 3 years ago, you could go change jobs, get a pay raise, and jump around. It's what everybody was doing.
Yeah.
And it was kind of crazy. It was like the wild west of, labor markets. And so we're not in that environment anymore.
No.
First time job seekers struggling to find jobs coming out of college.
And you have a lot of people coming out of college that
so it's different. So I think, now we're in this situation where for a long time it was inflation. And now it's like, well, inflation, but the jobs market, which one's more important? How are they going to balance that? You could argue this till you're blue in the face, and Which, how do you do nothing and let it kind of work itself out for a period of time? Are you okay with inflation trending a little bit higher to try to deal with employment?
One thing
I don't
the
know
Fed
the answer.
doesn't Fed doesn't get asked this question, and they don't ever talk about it. And it's the M2 measure of money supply, and it was a massive issue in the COVID years we had, and that's like printed money from it's just printed money that the government hands out to people, whatever. In 2020, 21, it was the most we had printed since the Great Depression, right, percentage-wise. So most dollars ever, but most percentage-wise. And nobody really talked about it, but it's an issue that and the Fed never talks about it. If there's a surge in the M2 measure with unemployment being tough, with inflation not, pretending to not come down, you have a little bit of a perfect storm that nobody really talks about there that could create a little bit of a uneasy economic situation. Back to your point about young people not finding jobs too. The middle class and under, think about this in the sense that inflation was massive from 2020 through 2022 through 2023, whatever. And we interest rate were rising to combat that, right? And what has happened is, inflation's down a little bit, 2.9% or 2.8 or whatever, but we still haven't made up for all that inflation that happened over those years. It's still up quite a bit from 2020, which isn't that far away. The middle class is suffering trying to find homes, trying to find just normal things that have gone up so much in price that haven't come back down.
But they're not going to come down.
No, I know they're not, and that's the problem. There's a little bit of a gap there that hasn't been felt yet in the economy. Houses are eventually going to move slower. You're going to have, I think rents have gone up more than your salaries. I mean, there's a point where that can't keep happening, right? There's a squeeze moment where the middle class is going to be forced to stop spending, which will affect all sales, which will affect all companies and so on. Now, that's a long answer to.
Well, there's a lot of data out there. I've seen several articles talking about how, the top 10 or 20% of the workforce in terms of earners are the ones that are holding this market or in the economy up.
Yeah.
Right. Which is not sustainable for the longer term.
No.
Right. You need everyone participating and contributing. So Lee.
And I'll just to that point, sadly, the gap's widening.
Yeah.
I mean, it's, that gap of, the haves and the have-nots, if you will. I mean, it's widening.
Yeah.
And I don't see that changing anytime soon. And then, we've talked about things internally within this country that could derail this market. But, there's so many geopolitical issues that, we wake up and Russia's invaded Poland.
Sure.
China is moving tanks into Taiwan. I mean,
we had a
those sorts
scare
of issues
this morning.
With the telecommunications, we were talking about that. Yeah.
So,
in New York City.
we're such a world economy that any event like that could trip this market for a little bit.
On the positive side, February of 2020, the wage gap actually was getting really tighter than it had been in 50 years, right? From the top to the bottom. We had unemployment going up for all categories better than it had, or unemployment being better situation than it had been for 50 plus years. We can get back to those things. COVID kind of put us on this whirlwind of where we've kind of been in a new economy and we don't know how to, what it's going to shake out eventually from it. It's still in the system, right? Eventually that will get out. But I also think there's optimism with our technology companies, with companies coming back, with our lower corporate tax rates. There's things that are driving businesses back to the U.S., which will create better jobs, hopefully. So, I mean, maybe there's a light at the end of the tunnel, so to speak, on that. Maybe we
just got to get there.
Yeah, we just got to get there.
Well, and it's you can go back and look at any historical period. I was trying to see if I could pull up some charts here real quick, but bull markets, like there was crap going on.
Oh, yeah.
There were geopolitical issues.
Oh, sure.
There were, and so I agree with everything. And like all of this is true that we're talking about the concerns and the risks but like you can go find periods of time where like the market sold off because of those events.
Sure.
And you can go find times where the market's ripped right through it. Yeah. Maybe there's been some volatility, but you look at a 3-5 year period and it's like, hey, we were in a war and the market was up 10, 15% a year through that period of time. And
we have short memories. 5 years ago, we had COVID and the economy was shut down and
I know.
the market's ripped.
Yeah.
So,
yeah.
yeah. So like all of these risks are true and ever present. But that has always been the case.
Sure.
And so it's like just trying to figure out typically what makes the market sell off for a longer, like really truly sell off for a longer sustained period is just, it's not something that's staring us in the face.
Yeah.
And that's correct. It is something that would not even on anybody's radar.
It's the true like tail risk.
That's correct.
Right.
That's correct.
Really good sign of the market, though. This is something that's positive. When the market fell down in April, and I'm going to use the Dow, which I know the young folks don't even know what I'm talking about. When the Dow fell down to 37,000 in April, the market, the stocks on the S&P 500 and the Dow were relatively equal value. Their price was equal value to what they should be, right? I mean that they're never going to be equal value, but they were kind of in line equal value. And I'm explaining what that means. When we hit 37 on the upside the first time several years ago, our stock prices, the fair market value of stocks would have been around 30,000 on the Dow. We were overpriced. When it got up to 43 and fell down to 37, at 37 we were priced right, which means the company's sales and so on have caught up to the price. Does that make sense? So we're not that overinflated now than from actual equal price levels, which
I heard somebody, so Tom Lee, y'all know who Tom Lee is?
Tom's great,
so he was, and I may butcher this, but a podcast I was listening to a while back, he was talking about how what's crazy is like the market's gone up, but like you look back, and I forget if he said a year or 2, 3 years ago, but like we're in a cheaper market than we were then, right? Because everything's caught up.
Technology stocks and AI stocks are ripping and roaring. I mean, my goodness, they keep meeting and beating expectations. Their expectations are high, and they keep every quarter. They seem to have great numbers, and they keep roaring past that.
Yeah,
which tells you. And by the way, I saw another stat that's pretty awesome. The AI surge that we've been in. It's less than 20% of companies are using AI. Less than 20%, and we've had this massive surge of AI, and it's all the talk and everything else. Companies are adopting AI left and right every day. So you think that's in the beginning stages of AI's relevance, which all the companies that are kind of driving the market right now are attached to the AI world, and we're only 20% of companies into that AI world. So I thought that was a positive sign as well.
Yeah.
Interesting.
So, I encourage you to go look at I was pulling this up, and I'm not a historian by any stretch of the imagination, but go look up at like all the conflicts that were going on in the 80s and 90s.
Yeah.
Right? I mean, you've got the Gulf War and
it's real interesting to see all the conflicts laid over a chart.
And so from 80 to 2000, the S&P 500 annualized over 14% a year. Right. And just go, and I'm just cherry picking that time period.
But that's a great time period.
But it was it was a period where the market just kept going up. Yeah, there was volatility. There were a couple sell-offs, and it wasn't just a straight line up. But man, if you just stayed invested and stayed through it, it went up. And so I say that to say, like, I'm not saying that's going to be the case this time. But it is encouraging and can be helpful to go back and look and remind ourselves that like this time is not unique. In the sense that it can feel in the moment. In the moment we can tell ourselves,
correct,
we've never been here before, we've never had, blah 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 blah, and it can get kind of spooky feeling.
Hey, this is a really side subject, but Reagan took over he got elected in 1980, took over in 81. He brought in Milton Friedman economics, right? And then we ran Keynes forever, and then Milton Friedman, and then we went to Keynes back in the 2000s, right? End of Bush to Obama. And then we're back to Friedman. And I know that a lot of people don't even know what I'm talking about, but these are two different ways of looking at supply side, demand side economics, right? And when Reagan took over, and he had a lot to unwind from massive inflation, the Iran, the hostage situation where America was in trouble. And gas prices, cars were lined up to get gas. It's just nuts to think about where we were at that point. It took a few years to fix that. And then from about 83 through really through 9/11, through the tech burst, I guess, of 2000, the market roared from, and it sounds really silly, but there's a direct correlation of the economic supply side versus demand side economics strategy that our Fed chairmans, presidents adopted, and we're back to that adoption from about 20 years of the other way. And the market's been great through both, by the way. It's not like I'm making a conspiracy, but I'd like the supply side, less government, and I think that's a positive for the market going forward.
Yeah. Milton Friedman, going back to
Yeah.
Econ 101 there.
They don't even teach
college.
him in college anymore.
They don't.
It's just ridiculous. Anyway.
Yeah, well, good conversation. So talking about, how do we set ourselves up to pay less taxes in retirement? A lot of planning and things that you need to look at and be aware of there. And then also just kind of the current bull market, where we're at, and some of the things that, to be aware of, and things and risks that, could stop it. So anyways, good conversation. Appreciate you guys being here. As always, we appreciate you guys watching and listening. Give us a like, subscribe to the channel. Feel free to leave a comment. We always love checking those out. And we will look forward to seeing you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.